If I lost everything tomorrow, no portfolio, no positions, no head start, and I had to restart in crypto from zero, this is exactly what I would do. No hype, no gambling, just data, structure, and positioning. This is for educational purposes only, not financial advice. Always do your own research. The first thing I would focus on isn't a coin. It's liquidity. Crypto historically expands when liquidity expands. When real yields fall, when bond yields roll over, when central banks shift from tightening to easing, that's when risk assets breathe. In previous cycles, Bitcoin's strongest rallies followed shifts in monetary policy expectations, not random headlines. When the U.S. 10-year yield trends lower and markets begin pricing in rate cuts, risk appetite improves. When global M2 liquidity growth accelerates, Bitcoin has historically followed with a lag. If yields are rising and policy is restrictive, I don't go aggressive. If yields begin falling and liquidity expectations improve, that's when I start scaling exposure. Liquidity is the tide. Crypto is the boat. Next, I follow capital, not influencers. Today we have something previous cycles didn't. Spot Bitcoin ETFs. Since launch, cumulative net inflows have reached tens of billions of dollars. That is structural demand from institutions. But flows fluctuate. During periods of macro uncertainty, we've seen multi-week outflows. When confidence returns, daily inflows spike back into the hundreds of millions. If I'm starting from zero, I'm watching for sustained net inflows over multiple weeks. I'm watching assets under management grow consistently. I'm watching whether institutions are adding exposure during weakness. Institutions don't move emotionally. They allocate based on models, risk premiums, and liquidity conditions. If they're positioning, I want to see it in the data. Then I go on-chain. I track long-term holder supply, coins held for over 155 days. When that metric rises, it shows conviction. I track exchange reserves. When reserves decline, supply tightens and upside pressure builds. I'd monitor whale wallets holding over 1,000 BTC to see if they're accumulating dips. I'd also watch stablecoin supply growth because expanding stablecoin supply often signals fresh capital entering the ecosystem. If exchange reserves fall, long-term holders increase, and stablecoin supply grows while price compresses. That's classic accumulation behavior. Then I look at derivatives. Open interest tells me how much leverage is in the system. If open interest spikes while price stalls, volatility risk increases. If funding rates are excessively positive, longs are crowded and vulnerable to liquidation. If funding is neutral or slightly negative during consolidation, positioning is healthier. Crypto doesn't just move on spot demand anymore. Futures and options markets amplify moves. I don't want to rebuild from zero in an overheated leverage environment. I want clean structure, balanced funding, and controlled open interest growth. If I'm restarting from nothing, risk management becomes everything. I wouldn't go all in. I wouldn't over-leverage. I would scale. Maybe I deploy a portion of capital on early liquidity improvement. Add more when institutional inflows confirm. Increase exposure further when on-chain supply tightens and macro conditions align. Not prediction, alignment. I would not chase green candles. I would not buy because something is trending. I would not let social media dictate entries. Retail loses money chasing momentum without structure. Institutions win by waiting for convergence of signals. The alignment I'm looking for is simple. Falling bond yields, sustained ETF inflows, declining exchange reserves, stablecoin supply growth, balanced funding rates, and strong equity market breadth. When liquidity, institutional demand, and on-chain structure align, crypto historically doesn't grind slowly, it expands aggressively. Right now, we're in a compression phase. Liquidity is neutral tight. Institutions are active but selective. Whales are accumulating dips. Retail sentiment is cautious, not euphoric. That's not distribution behavior, that's preparation. My base case is that if macro conditions stabilize and institutional inflows strengthen over the coming months, the next expansion phase is likely higher and sharp. Compression phases historically resolve with force. Starting from zero isn't a disadvantage. It's clarity. No emotional baggage. No sunk cost bias. Just structure and patience. Crypto rewards preparation, not prediction. If this helped, drop a like so more people start thinking structurally instead of emotionally. Comment what signal you're watching. Liquidity, ETFs, whales, and let's build smarter together. Subscribe if you want positioning before expansion, not after. This is GoldenBull. We don't chase moves. We prepare for them. I'll see you in the next one.